Good afternoon, investors. Welcome to our first bull session in the month of March 2024. My name is Mark Robertson. I am joined here by my dear colleague who is completely refreshed and flying in from Savannah, Georgia, and he'll be jumping from that helicopter to join us in any minute now in the square. Welcome back, sir.
Well, I'm glad to be back. I'll tell you, Mark, my wife and I probably walked 3 miles in New York just in the airport. They flew us from Savannah to New York and then over to Detroit on the way home. And that airport, JFK in New York, you can just walk and walk and walk and walk and walk. We got home and we went to bed and we slept for about 12 hours. So.
Ah, yes, the pause that refreshes. All right, so the Buttonwood is clearly on display there. I'm not sure how far we'll get into that today. We do have our round table tonight. It is our black tie and red carpet edition, and everybody's on pins and needles as to who walks away with the golden statues. And I did clear a little space on my mantle just to foreshadow a little bit there. Anyhow, we're also joined by a special guest, Kim Butcher. Kim is back with us after being absent every once in a while. She may have had to jump off though. I've been
No,
forewarned.
I'm here now. It's going to be tonight. Well, I'll be maybe jumping back and forth.
Okay. Well, greetings, Kim.
Hi.
So you're still redoing the condo? Is that what's going on, Kim?
Concrete restoration of the building.
Oh, nice. Okay.
The redoing that I'm doing is like taking out the old baseboard and, painting walls. I'm doing basic stuff rather than this building was built in 1965, and after what happened at Seaside in Miami, you got a lot of salt damage to the concrete building, so they're doing that now.
Well, if you need any new windows, I'm sure Ken can hook you up with a Technoglass sales representative.
I'll take it in consideration.
All right, let's get underway. We are going to talk a little bit about GNTX. That is one of the stocks for tonight's roundtable. We'll take just dip our toe into the red carpet stuff that will be going on. Talk briefly about Buttonwood and a couple other things, including Ken Williams' gift to us of Joseph Carlson. All right, so let's go ahead and get our unofficial disclaimer out of the way. This is our weekly reminder that Portillo's is not a sponsor of this session, even though they should be. And that happens to be, I believe, a relatively new store in Springfield, Illinois. Land of Lincoln. Here is the official disclaimer. No investment recommendation is intended. Everything we do here is about education, illustration, and demonstration. So what we're basically trying to do is share what we have witnessed and learned together over the last approximate 8 decades with the modern investment club movement. In other words, how to discover companies, how to study those companies, and how to decide where they fit in a portfolio design and the maintenance of said portfolio. So that's what we're doing here. We'll be sharing our opinions on those things. If we happen to own a stock that we're kicking around, we will try to remember to disclose that, and it's up to you to make decisions about anything related to investing. We are not the boss of you. This will probably be a little bit truncated session. We have a roundtable tonight, that annual awards show. If you'd like to be added to the reminder list for that event, we're still able to do this, Ken. They can contact nkavula1@comcast.net. Is that still valid?
Absolutely. And we have directors that are able to help folks get added to our list. It'll take a little tiny bit of effort, but I'm not exaggerating when I say a little tiny bit of effort. Not much at all to get added to our list. We'll be glad to help you do it.
Okay, and if you have any questions or suggestions for future topics, our 2 email addresses are at the bottom of the page. All right, let's go ahead and get underway. Here's a little quick look at, again, tonight we will be celebrating the achievements of nearly 14 years of the roundtable with our knights and guest damsels and the audience. Then those are people across the top up there that many of you know very well, that have contributed stock nominations over the years, from Candace to Kim to Mr. Gologly to Charlene Hansen, Ken in the middle there with Herb, Cy, Susan Michelik checking in there, Ann Manning, Hugh McManus, myself, and Matt Spielman. So those are the people that we will be looking over their contributions tonight. And that arrow is pointing to the long-term performance of the roundtable in this roll call, performance perspectives. And we're quite happy with being above the golden line with the investing roundtable. Anything on here, Ken? I know you're going to want to talk about Neogen. Anything here that grabs you?
Well, just the considerable undervaluation at the moment of Google. I don't know whether that signifies a buying opportunity or whether it signifies real trouble in the company, but Google certainly is down for the year compared to a lot of the other things that are happening right now. So I think it's certainly worth a look by a lot of folks. Really great growth, a lot of other things. So I'm disappointed to see it moving down the list here.
Yeah, after we added it to Buttonwood, I think that was the last straw. It's been losing ground ever since. But you can see the performance of some of the other portfolios. We are going to talk briefly about a long-term perspective on Neogen. And even with some pretty, is it fair to say, turbulent couple of years behind us, they still have a pretty decent return since 1994. Good fun. All right, let's get underway. Here's just a quick preview of the stuff that we will include in tonight's roundtable presentation, where we talk about the best company picked in the last year, the best company all time, and then who beats the market the most. We're going to talk a little bit more here about the best picture, and then, of course, best long-term performance for the year and all time, part of the awards. But this is what I wanted to spend a little bit of time with here today, just reinforcing. Over the years, we've had some pretty good sessions here, Ken, and I know your attention has already gone to Maria on the right there. And Darla, that's a twofer for you, right? Darla
Yeah,
and
that was a
Maria.
twofer. Yeah.
But I mean, these programs going all the way back to an infamous story about Chinese pulled pork back in 2010. But if you go back and actually look at these in the archives of Manifest Investing, there's some pretty cool stuff. I still love the Jim Bowen presentation, Math Wins from 2017. How about you, Ken? A personal favorite?
there's so many really good, solid shows on this list here, Mark. You could spend the next month just doing one a month and keeping yourself fairly decently entertained by watching these. I can remember almost every single one on the list, and I doubt if I could pick which one is my favorite, but I like a lot of them on this list.
Yeah, these are some pretty solid topics. I had forgotten that we featured Eddie Elfenbein all the way back in 2013. Uh, Kind of interesting that happened. And of course, one of my all-time favorites, and you can see over here on the right, here's Kirk and Spock. This presentation by Hugh McManus back in 2011 is, more Spock, less Kirk in the realm of investing. Just really good stuff. So anyhow, tonight's nominations are as follows. Kevin Gologly for his Getting Chippy back in April 2023. And then again, a tip of our hat and great thanks go out to Ty Hughes for talking about the thrift savings plan for our government employees back in that was in October, not that long ago. Great presentation, more views all the time on that one. And then I couldn't resist putting in two guys and Maria. And we really have been all over, because if you go back and look at this, Ken, that was mid to late July when we were warming up the audience for our annual run. into small company territory, just upping the ante a little bit. And most of the stuff that we discovered between July and the end of the year, doing pretty well.
Absolutely. We don't want to jinx anything, but we're certainly having a different experience with this year's small company list than we've had with the last couple of years small company lists. And it's just echoing what's been going on in the market, that the Russell 2000 and a lot of the other small cap indexes have been really outperforming the other indexes, sometimes in a 2-to-1 kind of a margin. So I'm just so pleased that we found a list of real good, solid small companies, and that they're showing our audience what you can do in small company investing.
Absolutely. So this will be fun. This is basically decided by the number of views and the amount of correspondence received. So it should be an interesting time tonight. All right. Here's a quick
I'll have to
reminder of.
start clicking on Maria 4 or 5 more times here to get a few more views up, right?
No, YouTube is smarter than that. They only let you click in once.
Oh, all right.
So there's a limit. It's legitimate interest. All right. Here's a look at our long-term perspective on the market. Again, we are back near 10% for the return forecasts, and that is also pretty close to that blue line. So things are pretty fairly valued right now. That doesn't mean there's not opportunity out there. Far from that. There are companies out there that are getting attractive, in some cases more attractive all the time, but you can see all the various forecasts are kind of running together.
I don't know what you would call it, Mark, but I'm finding it fascinating. I've added another question to my visits that I make with clubs, whether they're virtual or whether they're in person. And instead of telling them what the historical return in the stock market has been, I've been asking what they think the historical return has been. And I've been getting values that are consistently down around 5-6% rather than up around the 10% that it actually is.
Mm-hmm.
I wonder what that bias can be attributed to. I think it's a question that we might want to ask ourselves, why the average retail investor that at least sits in our community is so pessimistic as to what the returns for the stock market have been over long periods of time,
It is, that type of research is done every once in a while. You'll see that question asked and a fairly broad spectrum of answers. I think that a lot of people, especially in our community, probably are blending or commingling real rates with absolute rates. The real rate of growth is the actual rate of growth minus inflation. So that can take you down to 8% ish most of the time. So maybe that's a cause of some of those type of numbers.
Could very well be. And they don't do a real good job of identifying what they're talking about on TV when they're talking about long-term numbers either. So that might help out in skewing the value. But I think we have to keep letting folks know that the actual value is up around 10% and has stayed there for an inordinate amount of time when it comes to history. I mean, we're not just talking about recent history. This value was holding back when Nicholson started his work in all this investing and investing clubs and investing in groups. All this idea that, and that 10% number is held pretty consistent, even given all of the outliers that we've had since 1900, let's say,
Yeah, and I usually stop at 1941 because that's when the controls on the modern stock market actually came into place. So that that also overlays the 8 decades of the modern
Yeah,
investment club movement. So yeah, good stuff.
kind of washes out the Wild West that was occurring prior to that. Yeah.
And it was wild. All right.
Yeah.
Just real quickly, I am going to second the nomination by Ann Manning of GenTX tonight. And this is a company that we've talked about a number of times. It's in the Buttonwood portfolio already. You're looking at a company with 11%, 10 or 11% growth, 20% margins, a PE somewhere in the mid-teens. That generates a return forecast of somewhere in the 13, 14% range. So you basically just notice these guys are basically pegging quality at the top here. These returns are near multi-year highs, these return forecasts, pretty much up straight and parallel. I think it's pretty easy to see why it's in Buttonwood. Here's the rest of the story. I'm not going to go into it in any great detail, but if you would like a guided tour, go ahead, Ken.
Mark, it is glossed over the proof number at the very bottom of that last slide too, and I really like it when that proof number sits with the same first two digits as the par number, and this one does. It emphasizes to me that the company is not camouflaging anything with cash, either in a positive way or a negative way. What you see is what you get, and I like it when they're sitting so close together where we don't feel obligated to adjust that 18 PE very much,
Right.
if at all.
Yeah, we're going to actually take a closer look at that here in a minute. So yeah, we won't just gloss over it. Anyhow, there's more information here. Again, I would just urge you to take a look at that article. That is a public article. If you want to share that with friends or family, it's a little bit lengthy, so grab yourself your favorite beverage, good strong cup of coffee, and it takes you through what I am fairly well convinced that if I have a handle on the information that's on these 2 pages, I've done an appropriate level of diligence, and I'm ready to decide whether something makes sense for a portfolio or not. So take a look at that. Here's what Ken was just talking about. One of the things, in fact, one of those presentations that was given a golden night a few years ago was this notion of projected return on value. If you're new to this, we believe it's a gateway to auditing or reconciling your return forecasts. So on the left side of this screen, and Ken, jump in anywhere that you need to scream from the mountaintops. Here you're basically looking at the income statement based generation of a return forecast using the PE ratio here. In this case, checking in at 18 and coming down here to 14. This is what Ken said he likes. Anytime these two numbers are approximately the same. And so the right-hand side here is basically taking the business model, taking a look at the 5-year sales forecast and taking a slight detour, going away from the PE. We're not even going to use PE over here, but we are using the projected operating margin. Keep in mind that that is what is depicted right here. So you want to have a handle on what your expectations for operating margin are going forward. Armed with that, you can now complete this calculation. The projected return on value is the projected operating income 5 years out into the future, as we always do, divided by the enterprise value. Some of the math is right here. You can see we took the 5-year sales forecast, multiplied it by that projected operating margin to give us this projected operating income. That's the numerator. The denominator is this enterprise value thing. And we're using a modified Greenblatt definition of this, market cap, which is the stock price, minus the cash that's in their wallet, plus total liabilities. Now, most of the people out there in the world of investing are using long-term debt here. Ken and I can both hold up our hand and say that that just causes all kinds of confusion and chaos, because this actually captures everything, whether they've got leases, whether they've got credit cards, long-term debt, everything. If it's a liability, it's in there. And that really calms down the whole situation. So you get the projected return on value. Again, keep in mind that you're thinking about the operating income of this enterprise 5 years from now and dividing that by the current enterprise value. And here's the calculation of the enterprise value. Basically, just as the math is shown right there, what is fascinating about a company like this is that they have no long-term debt. Not only that, they have almost enough money in their checkbook or wallet to pay off all of their liabilities. That's weird. It's a good thing. It's just very unusual. So these two actually line up pretty good. What else here should we reinforce, Ken?
Well, I reinforce the idea that that is market cap. So that's stock price times number of shares outstanding.
Yep.
That's where that number comes from. And I think that's measured in millions there. So that's 8 billion, 8.3 billion, 8.4 billion, right, Mark?
That's correct.
Okay.
Yeah, this is a neat company. So again, this reconciles pretty well. It doesn't look like there's anything terribly unusual going on. You can actually play what ifs with this. In this case, if we were to drop the PE down to 17, as is shown here, and we do this for some companies, when the difference is large enough, you can see how much it dropped the par down from 14 to 12.7. And you can, of course, do that same type of what ifs with all of this with the spreadsheet. All right. Let's keep.
Yeah, one of the most profound statements that I've heard about GenTX, Mark, that I would like everybody to remember going into tonight is that if you're manufacturing a car, nobody cares how it actually runs except the person that's driving it, but everybody needs a mirror, whether it runs with gasoline or whether the car runs with electricity or whether it's a pedal mobile like the Flintstones had. They all need a mirror of some sort, and GenTX deals with that kind of stuff, not with the kind of stuff that's going through major alterations right now in the manufacturing of automobiles.
Yeah, I mean, I'm not sure how I used to back up. Badly would probably be the answer. That backup camera is invaluable. All right.
And you figure out how to use it. Well, I tried to figure out how to use my backup camera. I kind of may have hit a few things because it's like, oh, I don't even know that camera's there. Oh, look, guess what? The camera is not high enough to know that someone's got a trailer that's too low for it to.
Well, they've improved those cameras over the years, though, Kim. So
that's why you're supposed to check your entire surroundings.
I did crunch.
All right, here's a quick look at the top 40. Again, this is the official scoreboard, which is reflected in some real-time pricing. It's a pretty interesting group. Several of the Knights are in here. Kim has reappeared at, where are you at? 25, number 25. Herb Lemko would like all of you to know that he's still there at 49. not shown, but pretty solid start. And there's a little bit of moving around. Still 1 month into the contest.
And I just want to celebrate Graham Stevens' monkey down at 87 now and falling. I want him to keep going in that direction, okay?
Well, it's been a while since we've had a club actually in the number 1 slot. They've always been a threat, and there's quite a cloud of clubs not too far off the lead here. But Four Corners, that is a group of very avid, dare I say, rabid investors from all over the country that they're a good bunch. We'll probably be hearing more from them going forward.
Kim, this isn't your countrywide club, is it?
No.
Nope. Okay.
We're Bionic.
Bionic.
Better
all
Investing
right.
Online Investment Club.
I am a little concerned about the invasion of the Texas stuff on here. So they're coming. They're coming. All right. And of course, the kind of a big deal thing. So many of you have written to me saying, get my groundhog portfolio up. I'm here to say that they're all up. And you should be able to find yours there on the list. That's just for display purposes on the left. The actual link to the groundhog scoreboard is on the lower right. And you can actually chug in. There's the Four Corners Club portfolio. And you can see that they've made some fairly intriguing selections for the coming year. They're probably going to be pretty formidable based on that set of companies. Did I jinx them enough, Ken?
Yeah, keep on talking, Mark. Okay.
they'll be sending me nasty mail now. These are always better to sneak up on, I think. All right, so those are there, and you can look into any of the portfolios. And we do have 182 entries this year, so
I
that gives
would
you some
love, Mark,
context.
to I would love to drill down into those two companies with the yellow on this portfolio, the BYD and the Extra Space Storage. I'd love to drill down a little bit and take a look at what exactly it is those companies do. Very interesting choices. I've never heard of either one of those. I
Well,
wonder, is that second one a REIT maybe even?
I believe it is a REIT corporate structure, but BYD is a Chinese EV company.
Aha. Okay, no wonder I'm
That
ignoring it.
they
All
they
right.
make, they make battery. Well, at some point, that's probably going to be a coulda, shoulda, woulda nomination. Extra space storage
Yeah.
is in the storage business, just like
Okay.
public
Isn't
storage. And go ahead, Ken.
isn't BYD the stock that Charlie Munger brought to Warren Buffett because that battery company?
Yes.
Yeah, thought so.
hmm So it'll be kind of fun to watch these guys. All right. This is what you missed last week, Ken. We're going to be spending a little more time with Joseph Carlson. I did go ahead and subscribe to his Patreon show, so I'm getting through some of the stuff. He does have a regular program. If you just search his name on YouTube, you'll find the programs, some fairly decent commentary on individual companies going back over 10 years. And this is a portfolio being built in broad daylight, and it's going to be some fun. So thank you, Ken Williams, once again. And we will be continuing to have some fun with this. Here's a quick look, and I just started this, just barely, so I didn't get very far along. I actually want to commit the companies that are in that effort to a dashboard so we can play along and watch more carefully. What we found last week when we talked about it, this notion of compounding companies. And Ken, if you've got a microphone, and Ken Williams, and you'd like to chime in, please do so. But what he calls compounding machines lines up pretty well with many of the companies we would consider to be core investments. And I think that will be borne out as this is built out, Ken. So, Ken Kavula, I think you would have some fun just doing a little bit of homework on Mr. Carlson, and it'll be interesting to watch this build out.
Yeah, Ken Williams. Ken, if you want to make a comment or something, I can't, you can unmute yourself. I've unmuted you, but you'll need to unmute yourself if you'd like to make a comment. There we go.
Hey there, yeah. Essentially, he defines compounding machines as companies that consistently increase their intrinsic value year over year.
Right.
And so, I guess you've captured all of the companies that are in his current portfolio.
Yeah, those are, I believe he refers to it as his story stocks, is most of these. And then he's got a couple other portfolios on the side that I'm still getting into. So again, thanks, Ken Williams, and Ken, based on the amount of traffic and people that you have nudged, I think you're probably already on the nomination for next February's Golden Knight Awards. So probably in nomination already. I'm not kidding, Ken Kavula. This one struck some nerves, and we're going to have Ken back with part 2 of that presentation after he does his next Model Club report.
Sounds really good. Sounds really good.
Okay, so let's switch gears and talk about Neogen a little bit. For those of you that are not familiar with Neogen, and then I'll hand it over to Ken Kavula. Neogen is a Michigan company, literally born on the udders of cows at Michigan State University in East Lansing, Michigan. And it's a company that they're into food safety. And we became aware of it. I think you actually might have beat me to the discovery of this one, Ken. So I'll turn it over to you.
Well, I've owned Neogen since the 90s. I've had a soft spot. I know you're not supposed to fall in love with stocks, but Neogen was my first really big winner, and I've held it through thick and thin. And recently, Neogen has changed the way that it has structured itself, and actually bought a huge portion of the 3M business that had to deal with animal safety and food safety. And now they are busy integrating that big portion of the former 3M into the Neogen family. Neogen used to be the kind of stock that you'd call them up in East Lansing and you'd say, we'd like somebody to come to our investment club and explain what your stock does. And the guy would say, certainly, what time is it? And he'd show up in his car and give you an hour, hour and a half, or as long as you needed to listen to about Neogen. And they'd invite all their shareholders once a year to a huge picnic right on the grounds in East Lansing. And you'd get to meet other shareholders, but you'd also have access to all of the bigwigs, the CEO and the CFO and the IR person. And it wasn't a very large group, but it certainly was an engaging group of people to go to, and a lot of fun. A great field trip for an investment club, I'll tell you. The very first presentation that I ever made on the national level was a stock study of Neogen. This was only the second time that Better Investing went online with a webinar program, and it was this particular program right here, August 4th, 2010. Doesn't seem to be that that long ago, but you know, we're almost 14 years away from when BI decided we were going to go online all the time and began to have volunteers preparing studies to put online and to have people listen to. This particular study, I got a lot of help from Terry, and I can't for the life of me remember Terry's last name, but he was the longtime IR person for Neogen, and he was so helpful in putting this together, knowing that this was going to be kind of be a model for lots of other stock studies that were to follow. So I don't know what you've captured here, Mark, but maybe just a
some.
couple of the slides.
I just thought
Okay,
it was
well,
kind of neat because it's going back a
yeah,
little over 10 years and it's back during the heyday. So
yeah.
kind of interesting to see what it looked like at that time.
Yep, there's the mission of the company, founded in 1982. So it has a good deal of history to it. Neogen was known for its good neighbor policies in East Lansing. It's still known for that. Instead of building buildings, Neogen was much more willing to go into old structures in the city of Lansing and East Lansing and redo those structures from the inside out for whatever they were going to be used for, whether it was office space or lab space or production space. But today, when you look at the different buildings that Neogen occupies, you'll see that they fit right into the particular neighborhood, and they've saved some fairly interesting structures from the wrecking ball. A really good neighbor kind of policy that I really appreciate.
Yeah, they fit right in. There's no doubt.
You can see back then what their market basically was made up of. A lot in animal health. You could find their items at a brand new store that was opening up around the neighborhoods around me called Tractor Supply, and there was a big display in every single Tractor Supply about all the animal diagnostic products that you could buy. They were all branded Neogen products, and you could buy them for your horses and cows and sheep and pigs and whatever else you might happen to have on your gentleman farm. These weren't real farmers for the most part, but they thought they were farmers, and Neogen sold to everybody. Neogen also sold a lot of stuff to places that you wouldn't expect. I was a principal at the time I did this presentation, and we had a Neogen product right in our cafeteria. It was a swab attached to a machine, and every evening after the cafeteria had been cleaned, our cafeteria manager would use that swab and swab various random surfaces to test for peanut residue. You know how devastating a peanut allergy can be to a young person, and this swab helped them determine whether there was any peanut residue. They tried not to bring any of that kind of stuff into the cafeteria, but I think everybody felt a lot safer after that swab tested a lot of the surfaces where they were going to be preparing food and everything. A very interesting company. Its biggest product was a cream that made cows' udders soft and pliable so they could be milked more easily. The cows really liked it, I'll tell you, and a lot of the women, says Terry, that used that cream decided it was as good a hand cream as anything else, and it was being used as a hand cream, even though that wasn't its intent originally.
Oh,
What's the next slide show, Mark?
I can
don't
see
know.
the display at Tractor Supply now. Go ahead. It shows them up straight and parallel. That's what it shows me.
This is a sentence that began its life in the Mid-Michigan chapter, Up Straight and Parallel. It began with a presentation that we made to our model club, where we were asked to characterize what we wanted the lines to look like, and we got tired of saying railroad tracks, so we came up with Up Straight and Parallel, and then we started telling people to chant it. And then it spread all over the country. And today, I don't think there's a novice anywhere that doesn't understand what up, straight, and parallel means. And Neogen certainly was a poster child for up, straight, and parallel at that time in history. Next slide. I'm showing the consistency of the growth on this slide, and those straight lines show consistent growth, and all I was showing was that growth was somewhere around 16 and a half, 17, and it stayed somewhere around 16 and a half, 17 for an awfully long time. We had taught prior to that it was difficult for a company to go over 15 for any 5-year period, and here was a company that was doing it for a longer than 10-year period, and we got a lot of folks at it was called NAIC at that time. We got them to take a look at small companies and note that they could grow at a much faster rate for a longer period of time than anybody had anticipated when we were putting some of our educational materials together. Next slide. Here we are using 16% for the growth rates. We're not going to go through this entire presentation. It did take a long time. It was a 23% potential appreciation. That's a pretty nice par value at that time. And I was making the point that we were looking for par, and that was the whole reason that we did the SSG. It was not to determine sales rates and earnings per share rates, and it certainly wasn't to call out PE values for the next 5 years. It basically was to try to figure out what the potential was going forward, so that whether or not it was going to be something we wanted to buy or we didn't want to buy. So very interesting that we tried to refocus the SSG way back in the 90s. We tried to refocus the SSG back to section 5, where the original focus had been, rather than in section 2 and 3, where a lot of the focus had moved to. Next slide.
Very true.
Yep, and
Well,
here's Mark's study of Neogen then. Yeah.
Yeah, this brings it into the current context, and the attendees' question basically is, well, what are we looking at now? What has captured our attention? And I think you can see fairly clearly that there's one heck of a speed bump here. The stock price basically went down dramatically. You have a year with negative earnings, and you can draw a line through here. This is when they bolted on the 3M food safety division. So the thing that Ken and I have talked about is, this company had such a consistent, dependable track record, and now you basically are jumping to the new company. And could this get interesting once again? That I believe this quality situation is going to reverse and go back this way at some point. That's what I believe, because the 3M assets are also pretty solid. So really, it is kind of the answer to the question, what do you see this company doing after this transformative speed bump? that they experienced in 2022 and 2023. So I don't know, Ken. I think it hinges around that operating margin expectations. Is it going to go back where it was? How does the new product mix with the 3M products? Where does that put this over here? Is the
I
question.
think these margin calls that you're making, Mark, are certainly in line with any analyst that I've read that is discussing Neogen. There's a great deal of optimism that Neogen's management is going to be able to turn around the unrealized profit in a lot of the products that 3M had in its stable, and it's going to go back to historical margin levels. And Neogen's historical margin has always been upwards to 20% in operation, and net margins around somewhere between 12 and 15%. So I think that if you're believing the analyst community, and they do this for a living, so I tend to believe what they're putting out. The projections that they're making out for the next 3 to 5 years, I think, are certainly consistent, analyst to analyst to analyst, and they bear some consideration when you're doing your own study.
Yeah, I do think, these numbers are a little bit light as far as most of us are concerned, down in low single digits, but I am drawn to these images out here on the right. I think what I would be tempted to do is, let's see, the buy below is actually down close around 10. I wouldn't be afraid to set an alert for, tell me if the Neogen stock price drops below 11. And at that point, I think you could probably get interested. If you have faith in this stuff all falling into place, it could again be an interesting situation. So I hope that answers the question that was asked.
Well, I also hope that nobody is hearing either one of us saying that we think Neogen's a buy right now. But
No.
If you already hold it, I think it's a very interesting situation for you to be in. The last time I told you that I own Neogen, and the last time I bought Neogen was sometime at the end of 2022 into 2023, when the RSI value dropped significantly below 20. I felt it certainly was a buy in there. And I'm reading a card which I did get somebody to decipher between then and now, Mark. Okay, and that card showed that we bought that stock under $10 at that point.
Yeah, that's why I say I think I'm going to put an alert on my portfolio to send me an email if it drops below 11, and revisit that from time to time. Because then you're basically dealing in this area here, and there's some support there. All right.
And I guess the last thing I want to say, Mark, is that I have not held this stock blindly. There were times when we had lots and lots of shares, my wife and I, and there were times when we had very few shares. But we have always held a small amount of Neogen through thick and thin, out of loyalty, if nothing else, and especially once this idea with them taking over 3M's product line came into the first glimmer of rumor and then became truth as we moved into 2023. So if you're feeling sorry for me, trading from $50 down to somewhere around $15, $16, $17, don't feel bad. We've taken our money off the table a long time ago, and we've been playing with the house money for a long time in this stock.
Yeah, and it should be noted that even at this level here, when you're talking long-term perspective, that's still a 12% per year return. So what was it up here? I don't know. We actually talked about it. Could actually go look it up. But 12% is nothing to sneeze at either for those shares in your desk drawer that you never look at.
Yep.
All right. Let's talk Buttonwood for a few minutes. Ken and I were kind of wrestling with it is going to be time to add. If we had a stock burning desire to add to the portfolio, we would. We're going to look at some options here. We do have enough for one position, so starting either next week or the week after, we will probably convert some of these Vanguard Growth shares down to cash and get them deployed. And Ken, while you were away, you were here, but you were apparently away. We do have Google in this portfolio, so that has.
I'm awfully happy. Mark asked me to make a recommendation on what to put in, and off the top of my head, about 4 hours ago, I said, "Well, let's put some Google in. It's really undervalued." But little did I realize or remember that we already had Google in the portfolio. So I think it's a decent stock to have in there. I'm interested in the fact that even though it's depressed in price, it still hasn't depressed itself enough to fall to the bottom of the percent of total list. Very interesting. Where'd that 2 cents in Visa come from, Mark? Any ideas? Or that
The
0.2, I said
0.02?
2 cents, 0.2% of the total. Where'd that $5.27 value for Visa come from?
That was a gift from the broker.
A gift from the broker.
A
Okay,
gratuity.
got it.
We just mysteriously ended up with $5 worth of Visa stock.
All right, we'll take it.
We might be adding to that at some point in time, would be my guess. But here is
there have been good times in the past 6 months when an addition of Visa would have been a very nice addition to anybody's portfolio. I'm not sure it's today, but last 6 months have certainly had some opportunity in that stock.
at least not as much today. Here's a couple.
Okay.
Here's a couple, in my opinion. Here's just a couple real quick screens. I basically went out and said I'd like triple play candidates that have top shelf quality above 90, growth rate of 12%, and a decent core score. And that's a short list. And we talked briefly about whether or not we want a regional bank in the portfolio and whether Axos might fit that bill. That might require some warming up. GenTX is already in the portfolio. So I don't know. Nothing is. Valvoline is a great company, but that's just a little bit lean for right now. So correct me if I'm wrong, Ken, but nothing's really jumping at us there yet.
Nothing off that short list is jumping at me except GenTX, and like you said, we already have it in the portfolio.
Yeah.
So
then go ahead,
if
Ken.
I were playing with this, and my to-do list is so long, so I don't think I'll be playing with it much. But if I were playing with this, I would remind people that you might add a few more companies if you change the quality to 88, or if you change the core score to 220, or something along those lines. You might, lengthen that list to 7 or 8, and not sacrifice an awful lot of what you're talking about in total idea of what you want.
Mm-hmm.
And
so the other place I like to go looking is for companies with a relative strength index. That's the traditional 14-day look back RSI 14. Anything less than 30 is interesting. And for me, if it's a really vetted company it's under 20, it really gets interesting. But what you'll find as you dig into virtually all of these is there's some chink in the armor right now that is bothering somebody. This XMTR, kind of an interesting company, Ken. They are spare parts on demand. They basically sound like a little bit like Fabrinet. We're going to hear more about Fabrinet tonight. It's an interesting young company that might be worth taking a closer look at, but did not trigger any significant interest at this point. Okay.
I own a couple of stocks on this short list, Mark. I own United Health. I own Forward Air. So it's interesting. I haven't done a RSI list in the last month or so. So I'm kind of intrigued that a couple of those stocks have shown up. I should take a serious look.
Yeah, and I think United Health and Humana is a good industry study. And
absolutely.
And then Apple showing up on this list is just a little bit weird, but they have been dinged a little bit, and there are some never-ending China concerns there, so who knows. All right, here's a quick reminder that we do put all of these sessions on YouTube under Manifest Investing, whether they be bull sessions or roundtables. And yes, Ken, the hot tub is still on the page. It'll be off. It'll be off pretty soon.
Well, I'm surprised there wasn't a special category for best performance in the water or something like that, you know. So,
Hey, don't antagonize me. Anything
all
could
right.
happen. Here's a reminder of our.
Better yet, Ken, I don't think I'd be giving him suggestions.
Well, he started off talking about, suits and shirts off and all that kind of stuff. So this reminds me of the TV series Suits. So anyhow, tonight our round table: black tie, red carpet, jammies, bring your own beverages. We'll have some fun. We'll probably try to kick the room open about 8 o'clock if we can manage it, Ken, for open green room tonight.
Sounds real good. I'll be there.
Okay.
Mark, if you want to make a note, Steve Emmerich would like, if we're interested, he would like to give us a little bit of history about the pumps and monitors used in an MRI and shedding some light on this stock we were talking about prior to the meeting today. Maybe we can make that a mini segment on the next bull session.
Okay, I'll talk to him about doing that. Absolutely.
Great.
Yeah, because I've asked him a couple questions about related companies in the area, so he certainly has plenty of background in that area.
Steve,
right.
Mark's going to get a hold of you offline then, and I'm going to put your hand down for the moment. And Mark, do you have anything else for us to talk about?
Just to show a little bit of creation. This is a picture of Lake Michigan taken from the shores of Door County, Wisconsin, courtesy of Susan Michalik. And sunrise on Lake Michigan, good stuff. And of course, I'm going to talk a little bit about TVs from this era tonight, so it's foreshadowing the remote control. All right. And that's all for now, unless you've got anything else, Ken. I was going to take you up on something. I wanted to show you something. You had asked a question I was unable to answer last week because I just wasn't thinking. And what it had to do with was the Buttonwood portfolio. So what I'm going to do is bump this up in size. Can you see that okay?
Yep, we can.
It's an opportunity to demonstrate something. So we'll go into the Buttonwood portfolio. Here it is. And you had asked the question, well, what's it look like without the cash and without the Vanguard growth influence here? Because again, 45% of the total is in Vanguard growth. So we're basically asking the question, how are we doing in terms of sector diversification and that kind of stuff with the companies that have been chosen so far? So you can go to the worksheet. Okay, just click on worksheet. I'm going to reset it so that everything is current. Okay, and then you can go in.
Great minds.
Yeah, so take the Vanguard growth out. You did this, didn't
you? Exactly what I did about 10 minutes after I asked that question. Yeah, keep going, Mark, keep going.
So I'm taking the cash out. So now we have the situation where we've set aside this stuff which was interfering with our vision. And now what we have is a look at the distribution of the portfolio. If it were me, I would avoid, it's not necessary to get preoccupied with this yet, but I would avoid technology and healthcare for the next election based on these two pieces of the pie. And then you would also ask the question, Ken, how are we doing on size? And we shouldn't be afraid to take on a larger, slower growing company at this point either.
So absolutely. And if I were focusing, I would definitely look for a medium or a large company, then not necessarily something really small. We know that it sounds counterintuitive, folks, but we know that if you focus entirely on the small, you might have as many other kinds of problems in your portfolio as you will have if you focus entirely on the large. Just a different set of problems. But we think balanced is best, and I would look for some more workhorses in this portfolio. Good, solid, medium-sized companies right now.
Yeah, and in fact, I set that growth criteria at 12. That was a mistake on the screening that I just did. I should be screening for something different. Here's another case of the portfolio talking to you. Now this is early. It's early, but just something to think about. All right. I just thought
Yep,
that was
yep.
a decent demonstration.
Absolutely, absolutely.
Anything else of consequence or merit?
Well, no, but I'm hoping that we have a large group of folks with us for our awards this evening, and I know we're going to make some pretty decent stock choices because I'm privy to the companies for tonight, and we have a couple of really interesting ones to talk about tonight.
It should be fun. So we'll hope you'll join us, and we'll have another black tie and red carpet gala. So with that, take care, everybody. Thanks for
Good
coming.
afternoon, folks. Bye-bye.